Hello everyone, welcome back to my channel. So this video marks the end of the week number 96 and final week in this Road to 100k realized return challenge, and we finally did it. We managed to surpass the $100,000 mark, and as things stand at the moment, I'm going to make a separate video just to show the statements that prove that we actually exceeded the $100,000. So this video will be just as usual about what happened throughout the week and where do we stand in our current positions and what was the gain for the week and all that. And so starting by the data, by the economic data, you see here in the calendar that there was not much to be concerned about. Consumer confidence continued to decrease. Even it's a slight decrease, not a big one such as the other consumer confidence indicator from last week, but still progressing in the wrong direction. But then here on Thursday, that was the highlight of the week, and not only because the core PCE, but also the GDP, the second revision that came about. Jobless claims, yeah, this was pretty much a non-factor. Durable goods orders, this was also very good. It increased quite a bit. This was almost 7 times as much. So this was actually a very, very good development. But in here on PCE, apparently the fact that even though on an annual basis this came pretty much in line with what was expected, and there's indeed an acceleration from the previous month, the fact that on a monthly basis there seems to be a deceleration from the previous month, and the fact that it came on the core basis came below the expectations, and also on the headline it came 0.4 instead of 0.5 as expected, and it is a reduction from the 0.7 in the previous month. And this apparently act as a dynamo for the market, because this apparently gave some strength that inflationary pressures may begin to ease up, and so the market responded very positively to this. Also with regard to the fact that here, as you can see, also on Thursday, there was a deal, or let's just say the inner linings of a deal that still need the US president's final approval, but this was apparently a deal to extend the ceasefire between US and Iran for 60 more days. You cannot read this because, of course, this is not a free piece of news, but this is apparently an agreement on a 60-day memorandum of understanding to extend the ceasefire and launch negotiations on the Iran's nuclear program. But still, this apparently gave some additional hope that propelled the markets, and markets have a quite big reaction on Thursday in the middle of the trading session. So yeah, this was pretty much the factors behind it. Now, when it comes to the second revision, this was again another downgrade relative to the initial reading of 2%. And here, looking at the numbers, and I want to shed some light on this, because as you can see here in the personal consumption expenditures, or basically the consumption aspect of the GDP, the growth was pretty much on services. I would assume that this is pretty much has to do with something along the lines of healthcare, again in line with what happened in the previous quarters. When it comes to investment, here you see that there is a big investment, a big jump in non-residential, especially in equipment and intellectual property products. Again, looking at what happened in the past couple of quarters, I would not be surprised. I did not look very deeply into the data, but I would assume that this has to do with the data center build-up, which was something that we already discussed several times here in our channel. And again, a big in line with what has been happening over the past couple of quarters, the residential investment, so the housing sector has began to dip again, just like it happened in Q3. But yeah, this is something that will probably continue to make to put upward pressure on prices of housing in the United States. When it comes to exports and imports, the trade deficit continued to widen because imports grew more by the exports. You see here that it continues to the import growth continue to come mostly from goods. So yeah, bringing the manufacturing home was pretty much a failed strategy by this administration. Even though, of course, they continue to export, especially goods and not so much the services. But again, this is something to keep in mind. And again, we come here to the elephant in the room, the government expenditures. And here you see that the major component that caused the government expenditures to increase 4.4% is again the non-defense sector, which has to do with all the current expenditures that the government has to fulfill, not only with social security, not only with interest on the debt, but also healthcare, for example, the Medicaid, the Medicare, and all that. And so this is something that is very worrisome. And I'd like to signal to the fact that you see here that government expenditures increased 4.4%. So we are on track. And looking here at this news piece over here, this is a news piece that came about from about 9 to 10 days ago. The federal budget deficit is projected to hit 2 trillion. This is the deficit, so the gap between the expenses and the revenues, not the total expenditure, just the deficit, just the shortfall, ranking among the largest in the US history. And this will add to this 39 trillion, which was expected to increase for this year. So this is the debt that was expected to be added, these two trillion. And if you look here, I just made a quick search here on Google. So the US GDP is around 32 trillion. So I just made a quick calculation here, and if you put this 2 trillion deficit, if you consider from the perspective of the GDP, this gives you a budget deficit of over 6%. And so, looking at this picture over here, you see that even with the deficit hovering around 5 to 6%, the economy just grows 1.6%. So if you try, like we mentioned before, if you try to balance the budget and you take that much money or most of that 2 trillion out of the economy, the US economy would have been in a recession. And looking at the numbers here, none of these numbers come close. This comes a bit closer, but do not come close to a 5 to 6% deficit. So if you take the fact that the government continues to pump money and pump demand into the economy, the U.S. economy would be in a recession for already. You can only see the data all the way back until the first quarter of 2024. So you see here that for this amount of time, at least, the U.S. economy would be in a recession. Again, something has to be done. This can't continue forever, and yeah, something has to give. But again, moving back to our data on Friday, nothing here to be concerned about. The business barometer had a big jump over here, and above reading above 50 is growth. So this was a very good signal. But this was not that important. The market continued to rise yesterday, slightly so, and on the back, of course, of the deal, that apparent deal that is in the works between the US and Iran. But again, I think the market at this point have already grown about 10 to 15% of the current valuation of the Nasdaq and the S&P and the Russell, maybe on the back of just hope. And yeah, decide whatever you want, but I don't see this as being good at all, given that on the economic front, the economy continues to flag, and this is not really good. But moving on from here and looking at the trades that we did, we managed to collect, and these are the trades that we did for this week. We managed to collect a little bit more than $2,026, which is not that bad given the fact that we had only 4 days. This was a shorter week, and we also had somewhat negative behavior in the market. The market came down in the first few days of the week. At some point, we had some of our puts in the money. For example, the IAU ETF, the puts that we sold here with a strike price of 83. We had these puts slightly in the money as also these. I think this GTX also went very slightly so in the money, and the puts that we sold here on the SLV, this one's S66, also went very close to being in the money. So yeah, this was something that it made me think that all right, we may be able to lower our cost basis further, but because of the recovery, it ended up not being the case, and this is where we stand at the moment. We have a cost basis here of 91.5, so I believe that the premiums that we'll be able to collect next week are going to be better than this one, because given the fall of prices that happened the week before, the premiums that we collected were not that great. You see here in the calls that we had, the calls that we sold, some of them, like these ones on the IAU and the SLV, they had quite low return, and these ones were a little bit better. But because now the price, especially for these ones, are closer to the strike price, these ones will bring us a better premium. This one will continue to be a drag, and this position is already quite big, but yeah, hopefully things will improve next week by the time the market opens. Yeah, I think this is pretty much what we had to show for this week. Now, this is the last video of this challenge. There's no point in posting anymore because we already surpassed the 100,000 mark. I put here the value, so you already exceeded quite comfortably here. the 101,288 dollars and 78 cents. And so yeah, I'll be waiting for suggestions on where we should move next. So far, yeah, I have some ideas in mind, but I would like to hear from you guys. And yeah, this is pretty much it. For next week is going to be a big week. Let's see here. Next week we have, let's see, so nothing here on Monday. We're going to have ADP here for on Wednesday, so this is going to be an important one. It's going to be basically a flavor for Friday, because Friday we have the jobs report, and this means that all of our all of our options will be maturing on Friday to capture the volatility of this event here, which is going to be the highlight of the week. Most of the earnings are already behind us, so there's nothing that really is market moving at this point. And so yeah, this is it. Feel free to leave your comments in the comment section down below. I'm also available on LinkedIn in case you need to ask me any questions. And as always, feel free to like the video and subscribe to the channel. And yeah, I'll see you in the next one, whatever it may be.